Richard, welcome. This is our 2022 Shark Tank Contest interview. Thank you for being here today. Our winner for the Shark Tank Contest is Gabriel Penton. He comes from South Coral, Florida, and he was the winner this year. So the Shark Tank Contest is held every year. We have the students watch the latest season of Shark Tank, and during that time, they select 3 companies that they would select to invest in, depending on the presentations and the different financials that the company presents. So they do a deep dive into those companies to see where they would allocate $1 million YIS dollars. And then they prepare a written brief on their allocations or a 3 to 5 minute video. So Gabriel this year was our winner. So I'm going to hand it over to James, who's going to do a little introduction for Richard, and then we can get started with our interview.
Well, welcome, Gabriel, and welcome to the YIS community. It is our honor and privilege to introduce Richard Folsom, who you have the honor of interviewing today. Richard, just to give a brief background, so Richard is the founder of Advantage Partners, a private equity firm that invests in Japan and Asia. Richard started his career at Bain and is a successful investor in companies and all throughout Asia and all throughout the world. He is a regional advisory board member for Young Investor Society from the Hong Kong chapter. And so it's such an honor to have Richard here. Gabriel is one of our leaders of Young Investor Society in the Student Advisory Board. He's been involved with Young Investor Society for 2 years, and we're so proud of Gabriel and all he's accomplished and his great work. So with that, I pass the time over to Gabriel. This is your time with Richard Folsom.
Okay, great. Hi,
Mr.
Gabriel,
Folsom.
and congratulations on winning the Shark Tank contest. Great work.
Thank you. I appreciate it. I've looked into your career.
Okay.
I actually have a blog called Teen Tycoon that works with entrepreneurs, and I interview them on a weekly basis. So I researched you and I was beyond impressed. So thank you for the opportunity to interview you.
Thank you. Appreciate it, Dan. So you're a pro at doing interviews too, then, it sounds like.
Yes, I try to be.
Okay.
So I guess the first question is, I noticed academically, your track record is very impressive. You went to Wharton. How do you think that your education served you professionally? As a result of your experience with a graduate degree, what would you recommend to young financiers in terms of education in the 21st century?
Yeah, and I think it's a great question. I think, first of all, probably the availability of various financial and business-related curriculum in the undergraduate level is probably a lot greater than it was in my day when I went to undergraduate school. And so I'm not going to say it's necessary to go to an advanced degree, to a graduate degree or an MBA. But in my case, I think there are a couple of things around it that I thought were really helpful for me. One, I sort of had the plan from the outset that I would finish undergraduate and go to work for 2 or 3 or 4 years and then go back and get an MBA. So that was sort of my plan from the beginning. And that allowed me to have a little bit more flexibility to explore and learn different things and not really be totally committed to some career or some business coming right out of college. And so that allowed me to, again, be a little bit flexible, spend 2 or 3 years getting some experience, knowing I was going to try to go to business school. And then at business school also to stay flexible and network and find out more about different industries and different sectors and see what I might really want to do. And it was at business school, I guess, that a lot of my earlier entrepreneurial aspirations sort of came together. And so having that time, after undergraduate school for a few years to work and then come back and learn about different financial frameworks, business frameworks, and other things at business school was a great way for me to, consolidate some of my experiences and think about what I might want to be doing going forward. And I went to, just in terms of age, I was 28, I think, when I went to business school. So that gave me a lot of time before then to be thinking about different choices.
That's amazing. So actually, you brought up a topic that was in my line of questioning.
Mhm.
How did the talents required for you to be a financier differ from the ones you needed to be a successful entrepreneur?
Yeah, that's also a great question. I think well, and what's a financier? And I was thinking about that as I was looking at some of your questions, um, and I was thinking about career choices in graduate school. Again, linking it back to that question, becoming savvy at financial investing and financier related skills is something that I think is not just a potential career path, but it's certainly something. It's a basic life skill and something that you want to have a part of your personal financial planning, regardless of what you choose to do as your career. And I would say you don't necessarily need to be a financier as a career to be a savvy financial investor in managing your own financial future. And so you can still have a lot of flexibility in other things. And I don't know that I ever really considered myself a financier in that regard. Um, More, I was in business consulting, management consulting, and then what we do now. Well, started a couple of businesses, and then came to our private equity business. But so I think I consider myself much more broader in terms of general management and operator and builder of businesses. Those skills, how do they differ from financial skills? I think I learned a lot of the financial side of things at business school. As James mentioned, my early career was at Bain and Company in consulting, and actually in the consulting industry, you're focused more on the P&L, meaning operations, sales, costs, profit. How do you grow profitability? So marketing and strategy type of things, and you don't really learn the basics of the balance sheet side. It's more of a P&L business than it is a balance sheet business. And so business school was good for me in that context to bring in a little bit more of the balance sheet side, more of the financial tool side, and to my experience that I hadn't had up until then. But then again, as I say, we were more involved in entrepreneurship and new businesses from the outset. So I don't know that I really consider myself at any point having been a financier and made that transition, but the transition from consulting to private equity or running a business certainly also gets beyond just sort of the basic strategy, marketing, and cost analysis type of things. I would say one of the most surprising things to me about starting a business over the first few years was the amount of time and energy that I needed to spend on personnel related issues, hiring, motivating, dealing with different issues that people had, and then cash flow and financing the business. So I was out there thinking I was running a business, but I had to spend actually the majority of my time on making sure we had enough money to run the business and making sure that the people were all properly motivated and problems were solved on the people side of things.
So that's very interesting because a lot of people, the way they see the career path is normally you'll go into either investment banking or private equity, and then you'll go into consulting after once you've gained experience. You did it the opposite way around. So would you change anything? What was the largest contrast, I guess, you'd see between consulting and private equity in terms of being a successful entrepreneur? Because from a consulting standpoint, it is a lot more P&L, reducing costs, whereas private equity is more entrepreneurship. I guess it's more people oriented because at the end of the day, business is people. Yeah. So how do you think that affected your career?
Yeah, and I wouldn't change it. But back when I started, I think coming at private equity from consulting was more the exception than the norm, as you alluded to. Coming from finance, hurting from banking or investment banking was the norm, and I think the industry is changing. If you go way back in the history of private equity, back to, maybe you've read the book Barbarians at the Gate, the KKR, RJR Nabisco deal back in the 70s, which sort of was one of the landmark deals that ushered in private equity and buyout investing. Investing back in that day was really a balance sheet exercise, and the RJR Nabisco thing as well. It was a sprawling, diversified company that had inefficient balance sheet, and so their whole investment thesis was coming in leveraging the balance sheet, cutting off and divesting certain assets to pay for the leverage. It really was a financial engineering model. And private equity and leverage buyouts really was that from the beginning. Leverage is a big piece, but the financial engineering piece was the key. And that's evolved over now a 30-year period or so from financial engineering being the core differentiating competence of private equity to P&L, meaning how can you effectively grow the operations of a business becoming the key. And even KKR as an example, back to RJ and Nabisco, they were the pioneers in the financial engineering side of things. They've also now shifted quite dramatically. They have their own in-house consulting firm, Capstone, which really does take on the sort of P&L side of things. So in the private equity industry today, the financial engineering of the balance sheet side of things has become commoditized, i.e. there's not a lot of differentiation. Everybody sort of has the same parameters within which you can do some of the financial engineering things. The real differentiators are how you can work with companies on strategy, operations, and growing them. How do you grow sales? How do you grow profits? The P&L side. But the other part of your question was the contrast from consulting to private equity. Sorry to be giving long answers to these, but as a consultant, while you're learning a lot of these P&L related things, the biggest difference is that you don't have complete visibility to or responsibility for execution and implementation. You're basically doing a lot of analysis, putting together a report and a presentation and making recommendations to your clients, but you don't necessarily get to see it through to results. And I think a lot of people that come from consulting, that's maybe their biggest frustration, is that they do a lot of that. They make what they think are really effective recommendations, but then in many cases they see that they don't get effectively implemented, and they don't have a role in or the responsibility to sort of bring that to execution and really to tangible results. And so people that want to be a little bit more involved in that and see the results of that, not just the analytical side of things, I think find the shift to private equity really attractive and motivating. And we do hire a lot of people from consulting, by the way. And one other point I'll make on that context, then sorry to get long, is that we do hire people from both banking and investment banking and from consulting. And in private equity, you do need to have both of these skill sets,
Factors together.
the financial side of things, but also the P&L and the operational strategic side of things. And when we look at people that come and join us, they come from banking. Is it easier for someone coming from banking or investment banking to learn and take on these skills of the P&L side, or is it easier from someone coming from consulting that has that to learn and understand and take on the skills of the financial side? And our observation is that the latter, coming from consulting and learning the financial side is actually easily, and we see a lot more people successful at that than coming at it from investment banking and trying to learn the operational consulting side, which to me says getting into private equity, coming at it from the consulting side is probably a more effective path.
Perfect. I think that's very interesting and very relevant in today's market, especially as many young people in Young Investor Society are entering the career world, entering into education. I personally, I'm starting college this summer, so I'm 15 years old, and it's interesting for me to see.
You're 15 and starting college? That's amazing.
So, thank you. So it's very interesting because I'm between like accounting or finance or entrepreneurship. So it's very relevant, I think, nowadays for everyone to be able to see what the different career paths could take you. Now, more so sometimes than just the being able to read a balance sheet, do a P&L, whatever it is that you're doing, the skills you learn as a part of your career are very important, and that's accumulated through experience. What would you consider to be the most valuable skill you've built over the course of your career?
Yeah. I don't know that you can point to any one skill or capability, but if I look at maybe two or three things, one that I find really important, and that is something I think develops over time, is the ability to accurately observe and understand situations and people. I mean, that's a huge one, I think, for me. And I would call that maybe the power of observation, which is not just seeing, but it's also hearing and listening and being able to process and understand, complex information about conceptual models or systems of behavior or business, or maybe just put it more plainly, just how things work or what's going on here, and really just understanding all of the components of something that's happening and how they're interacting and what's going on there. The ability to observe things like that accurately and understand new concepts quickly, and then to be able to internalize that and replicate it, or implement things. I think that skill is critical. I guess it's kind of hard to find how you learn that, but as I look at people, particularly that are coming in, as I mentioned, to a new business and learning things, just the ability to quickly observe, understand how things are happening, how they work, and then be able to internalize that and replicate it. That I think is a critical.
Now,
Yeah.
in my background research on this, and you can tell me if I'm wrong, I noticed apart from education, apart from skills, there's another very important factor, which is your perspective. Obviously, your perspective is much more global, perhaps, than the traditional Wharton grad student. What allowed you to broaden your perspective into Asia, particularly Japan?
Yeah, that's also great. And I feel really fortunate. I was when I was young student, I was fortunate to be able to take a couple of years off, sort of gap years, and participate in volunteer activity for my church. And I didn't, really select the location I would go, but I was sent to Japan. And so this is when I was 19 years old. And so that took me to Japan. I'd actually spent a couple of years in Germany earlier as a child. So I do think I had a sort of a home and parents who were, more international or global than normal maybe, and spent some time in Germany. And I thought, because of my time in Germany and the fact that I knew Japanese when I volunteered for this church activity, I thought they might send me to Germany, but they ended up sending me to Japan, and maybe that was because I had demonstrated the ability to learn new languages a little bit. But so I spent a couple of years in Japan when I was 19, 20 years old, and that really changed my perspective. And I guess I got hooked, so to speak, on Japan and learned some Japanese. And so then when I went back to college, I was originally a math major, by the way. And I came back to college and had changed to economics. And then I added Japanese major to my economics studies and looked for, again, and I had the plan I would go back to graduate school. So I wasn't really trying to learn hardcore, finance or business skills yet at that time, more just general economics and the Japanese language. And I decided I really wanted to look for job opportunities that would take me back to Japan and Asia. And if you look back, in history, Japan, this was in the mid 80s now, was the China of that period, when it was the fastest growing economy, second largest economy after the United States, and a lot of things happening, cross border with Japan and the U.S. And so I felt fortunate that I'd learned some Japanese and was in a position to maybe take advantage of some of the opportunities between Japan and the U.S. And that's what brought me here. And then I stayed here for my entire career in Asia as a result of that.
Now, I'd say for me personally, the most exciting facet of your career I saw was being part of the first ever buyout in Japan. What was the most exciting part of that deal?
Yeah, when I saw that question, well, so raising the first buyout fund in Japan, I think at the time, I wouldn't have called it exciting when we were working on it. And so maybe looking back, now down the road, looking back, yes, there's a great feeling of gratification that we were able to, participate in getting that industry off the ground and be a part of shaping the industry to what it is today. But I think at the time, and this may be back to another skill or trait to your earlier question, perseverance and persistence come to mind. and we were continually faced with rejection and people telling us all the reasons why what we wanted to do wouldn't work in Japan. But we believed and persisted, and we finally found two Japanese investors who were willing to take a bet on us, and then we were able to leverage those two relationships to develop relationships with several others, pull together a small group of investors to back what was a really small fund at the time. We only raised $30 million in this first fund. We took some satisfaction out of that because, you know, Bain Capital, and my partner and I both worked at Bain, and then we left Bain and started our firm. And we got to know the folks at Bain Capital back then in the day and saw what they're doing. And that's one of the things behind the idea we got for starting the buyout fund in Japan, was what we saw Bain Capital doing and really taking the consulting side of things and bringing that to private equity. So I think Bain and Bain Capital were the pioneers of that. And
Now,
sure,
to be clear, a buyout is when you purchase a distressed fund from another entity per se, or a business you buy out that's currently distressed.
It doesn't necessarily need to be distressed. So in fact, most buyouts, they're not distressed. Usually you're buying good companies with great cash flow and helping them grow better. But there is a certain segment of the buyout industry that is focused on distressed assets. But typically what we're talking about in buyouts is buying a company from its current owners and helping that company achieve a higher level of growth and profitability. And
so that is, sorry to interrupt you, that is in essence the dream of most business owners. That's the exit strategy for them. And then you use your P&L experience plus your newly acquired balance sheet experience to really grow that organization into what it could be after the foundation has already been created.
Yeah. We have a definition that we like to use. We call the definition of M&A, or buying a business, is taking a certain business and removing it from the constraints that the current owner, whether it's an individual owner or a corporate owner, there are certain constraints on the business that aren't allowing it to achieve its full potential, removing it from those constraints and putting it in a new set of circumstances where it is able to achieve its fuller potential. In Japan, you nailed it. 70% of the deals we do in Japan are founder-owner succession, where a founder-owner has built a business to a certain level of growth. They want to professionalize management and allow the company to go to another level of scale and growth, and it becomes an exit strategy for them, as well as working with us to make the management transition.
Of course. Now, in perseverance, obviously you, in order to achieve that level, which in the finance world, maybe a lot of people would say, like, that's a small fund, but for someone who's starting as an entrepreneur, raising that amount is beyond impressive. So congratulations to you. You must.
And I did just finish my thought. So Bain Capital, we look back at Bain Capital, their first fund, they raised $27 million in 1984. And so we looked and thought, we patted ourselves on the back. So when we raised $30 million, that's a very small fund today, that we were starting at about the same scale that Bain Capital started at.
That's amazing. Really, congratulations. And I mean, that's, though, you had to be able to collaborate, you had to be able to communicate and effectively pitch to investors. And so my next question for you is, what was the importance of being able to collaborate your idea, your proposal, your pitch to these investors, and how did it serve you in your efforts with others to collaborate?
That, and then get back to skills. That's one, now that you remind me of it, that over time I think has come to be one of our biggest strengths as an organization, is our ability to pitch and communicate to institutional decision makers. These are typically institutional investors, large corporates, or financial institutions, and helping them understand not only what it is we're pitching to them, but also our whole thing about trying to make these pitches to help them understand what their decision processes might be, and how we can pull together the components and the information that they need to affect a decision within their organization. And these are generally mid-level managers at a large institutional investor who are trying to move forward a decision process. So yeah, I think it's huge that being able to communicate, and it gets back to what I said earlier, observation as well. As you're in this process of making an initial pitch and introduction, you're also trying to ask questions and learn information about their organization, their decision process, what's important to them, how we can then go back for a next round and position this to give them all the pieces they need to effectively make a decision within their organization. So it is an iterative process, and communication and observation, and taking the observations and putting them back into the follow-up communication is a huge part of that.
Of course, of course. Now, you mentioned that the most exciting part of that buyout was raising the money for the fund. If you were starting today, again, your career, or you were in that phase of your career, what would you change? That was your favorite part and you were very successful. But what do you think that you'd begin differently? Who would you be marketing to? How would you have adapted it in hindsight with all the experience you've gained now?
Yeah, I mean, that's a hard question to answer. I mean, as we look at, and I don't know if I have a great answer. We started in Japan. We were the first buyout fund in Japan, a private equity fund in Japan, and we've grown with the industry. But I would say, hindsight, the industry in Japan has not grown to be as large and pervasive as we had hoped. I mean, it's a much larger industry today. Our first fund was 30 million. Our next fund is going to be about $1.2 billion. So it's grown, but it has not achieved anywhere near the level of penetration that you have in North America, Europe, or even other Asian markets. So one thing in hindsight that we debate ourselves is, okay, we've become the leader in Japan in private equity, but it's a small market. Could we have been better off starting in China, for example, which is now a huge market, and funds there of our peers are 5 and 10 times the size of our fund. So that's led to some of the things we've done to expand geographically now, where we are expanding outside of Japan. But we ended up becoming leaders in one of the more limited markets out there, for better or worse. The way we did it, I still think, the way we did it in Japan, I don't think you could change a lot to that. But maybe expanding internationally sooner and looking at other markets outside of Japan earlier on could have been something we could have done earlier and better.
So as I looked into you and your career, now that you mention your church, it becomes quite evident that you really have a passion for giving back.
Mm-hmm.
As you went through your career as a successful business person, not financier, not entrepreneur, business person, not consultant, because I think business person is what could identify you more 360 with all the things you've done. What made you find that importance in giving back, particularly to young entrepreneurs?
Yeah, that was something that my partner and I sort of built into our mission statement, our core values from the beginning. And so I mentioned my church, and I'm a Christian and church member. My partner is Japanese and not Christian. He comes more from a traditional Japanese Shinto and Buddhist background. But he shared, and this is something becoming partners we found very important, is understanding that we share the same values and beliefs in terms of how we should build our business, how we work. And we had built in, and we have a stated investment philosophy that part of our value is that we want to make sure that all of the stakeholders that are involved in investments in the businesses that we are involved in share in the economic value and benefit from the process of us having become an investor in the companies we work with. So that's been embedded in our organization and culture from the beginning. But I know there's a great story I have that reinforces this from others too. And I don't know if you've got how much time we've got, but if you're interested in a good story,
I'd love that.
I mentioned that we got some of our early ideas from Bain Capital when my partner and I were back at Bain, and we got to know some of the early guys at Bain Capital. Mitt Romney, who you may have heard of,
Yes.
was leading Bain Capital at the time. And when we went to start our fund in Japan, we went back to Mitt Romney and said, "Hey, we want to start a buyout fund, a private equity fund in Japan. Could we collaborate with Bain Capital?" And Mitt was very gracious, and we talked about it. He was interested in potentially partnering with us. At the end of the day, he went to his partner group and said, we can't get a consensus to do anything outside of North America right now. This was back in the 1990s. He said, we're doing so well in our practice in North America, we don't want to be distracted by something halfway around the world in Japan. So we won't partner with you, but we're happy to, let you pick our brains, look in some of our files, look at some of our case examples, whatever you want to ask, just ask. We're happy to, share our experience and our knowledge with you. And
this was with Mitt Romney.
This was Mitt Romney. Yeah. So wow. I had known Mitt. Well, there's another backstory about how I know Mitt, but I got to know him when I was at Bain back in the day, and he was still leading Bain Capital. And again, he was very gracious. He arranged interviews with his CFO, his COO, a couple of the other partners there. I really did. I went back and made a list of 250 questions I wanted to ask about private equity and how they made their investments, how they ran various parts of the
like me with you.
Yeah,
that's so funny.
And he did. We spent a week there in Boston, again, asking every potential question we could, and they shared some of their financial models, some of their case examples, some of their investment memoranda and stuff. And then we went back and started this business on our own, not being partners with Bain Capital. Incidentally, 2 or 3 years later, they did want to be in Japan and Asia. So their change from just being North America focused to now going to Europe and Asia changed. And we were able to return the favor somewhat as they came to set up in Japan, and we helped them, and we talked a lot with the guys that come and led the expansion of Bain Capital in Japan and Asia, and we've co-invested and we collaborated on a number of deals together. So we have a very good ongoing relationship, but there's a rest of the story to this. So that was 1996, 1997, so 30, a long time ago. Fast forward about 25 years. And I had the opportunity to meet one of the other senior guys at Bain Capital at the time, a guy named Bob Gay. And I had heard of Bob Gay back in the early days, but I'd never met him. So I met Mitt and Mark Nunnally and Paul Edge and some of these other guys, but I never met Bob Gay. I just heard of him. But he ended up being in Japan after we retired from Bain for some other things just a few years ago, maybe 5, 6 years ago. And I had the opportunity to meet him. And he knew of me and I knew of him, but we had never met each other over these 25, 30 years. But we met and interacted on several occasions in Tokyo when he was there. And I learned something from him that goes all the way back to the time when Mitt Romney and Bain Capital were so gracious to us in sharing information. And that was that he was one of the early founders of Bain Capital as well, with Mitt Romney and the group. And he said he and Mitt, when they started this, they made an agreement to each other. They said they wanted to make, I'm not sure exactly how they phrased it, but they wanted to have helping others or giving back, helping others always be a core part of their values and a part of their business. And if they lost sight of that, it wasn't going to be, any success would not be as meaningful if they lost sight of helping others. And so I heard this description from Bob Gay about what he and Mitt Romney decided 30 years before. And then I realized I had this light bulb go off. The whole reason that Mitt Romney was so gracious and helpful to us is because he and his partner had this helping others core value, a part of their doing business. And so when we were looking to start our business in Japan, I didn't know that was part of their understanding, but they were very gracious and helpful to us. And we've had that as a core value of our firm as well. And it was really gratifying and a great experience to have that come full circle, about 25 years, learn that Mitt and Bob Gay had, a similar core value about giving back to others, helping others, and always having that be part of their culture, not losing sight of that, no matter what sort of successes they get to as a core part of their business, and that we were the beneficiaries of that. For me, that was a really great moment, and just reinforced that we should continue to have that be a part of our values as well.
That's amazing. That's really incredible. I think that it's super special to give back to the community, and I can't tell you how much it means that you're taking the time to do this interview with me. I hope that I've done well so far.
You've done great.
Now, thank you. Now, what do you think? The next question, I guess, would be, what impact did networking have throughout your career? Was there any other memorable story you might have? Was there anything that you really learned from these people? Any anecdotes you might want to share? Because that's a very important part, and I think that it also encompasses the three major facets of your career in terms of education, perspective, and really all the success you've had?
Yeah, I think networking, as you term it, is really important. I think it's also can be termed another way. Really placing value on relationships and making sure that relationships are mutually beneficial. It gets back to the make sure all the stakeholders involved are benefiting from our investment activity, and really taking an interest in and care for the various stakeholders, participants, people that we work with. And we have a part of our value there is we also believe that considering the interests of all the shareholders and placing value there is not just an altruistic thing. It's actually, we believe it's also a self-interested thing, because it's the law of the harvest, so to speak. You reap what you sow. What goes around comes around. The things that you do come back to you. The things you do for good will ultimately come back to you. And we build that into our investment philosophy, such that if we make sure that all the stakeholders in our investments benefit from the investment activity, then they'll have great things to say about us. They'll have had a good experience when we were a shareholder of their business. And that will lead to more good companies wanting to have us become their shareholder, more top caliber management wanting to work with us as management at the companies we work with, the best caliber employees wanting to come and work with our firm, the best banks and financial institutions wanting to provide the debt to our firms. All this virtuous cycle of the best players in the industry wanting to be a part of this investment activity, and that itself leads to our success going forward. So this really is a virtuous cycle of success that gets created as a result of that. I think I lost sight of your question. What the question was again? And see if I'm answering it.
The question was about networking, and you definitely encompassed the question very well. Your career obviously precedes you. So the last question for you is, what was a time you made a mistake, or a mistake you made, and what did you learn from it? What impact did it have from your career?
Yeah.
I think that when we're young, we all make mistakes, and sometimes
not only when we're young, we make mistakes when we're older.
We make them every single day.
Yeah.
And that allows us to learn and grow. So
okay.
Maybe there's one you'd like to share with us.
Well, and yeah, I saw this question. I've made lots of mistakes over the years. There's no question, and certainly learning from mistakes is a huge part of life. And you can't grow and succeed without making mistakes, because that means you're trying new things, different things that you're not so sure how they're going to go, and inevitably that means there's going to be some trial and error, there's going to be some mistakes, and there's going to be some learning. But you can't build anything or become successful at anything without having mistakes built into the process. But yeah, there's one particular one I thought of in this context, and I don't know how detailed I should get into it, but we had a huge setback in our business after the global financial crisis in 2008-9. That was the result of some poor decisions that we made, and it was a result of external factors. Certainly, we probably wouldn't have been in the situation we were in if not for the global financial crisis. But that really, I think, in one sense, highlighted potentially some of the mistakes that we made, and maybe we got a little bit caught up in ourselves and our success, and made out, took some risks and did some things that, in hindsight, we shouldn't have. And led to a huge setback in our fund. And this it was an investment we made in a company just before the financial crisis. It was a large investment. It was going to be the largest investment or the largest acquisition we'd ever made. It was a really popular deal. Everybody wanted to be part of this deal, and we ended up being positioned to get the deal. But it was larger than anything we'd done before, so we had to overextend to do it. And we needed to raise additional capital from other co-investors to get this deal done. But there were several mistakes in the process, but probably the biggest one, or the most, I guess the most detrimental one, was that we have some policies about portfolio diversification, and this is a good basic financial skill, and that James and YS teaches, and that is making sure that you have good diversification in your portfolio and you don't get overexposed to a single asset. And we have the same thing in our funds. Typically, we have a 15% single investment exposure limit. But we also had a mechanism where we could, in cases where we saw where we needed to raise additional capital and syndicate some of the deal, that we could bridge another 15% and syndicate that or sell that down later, with the ultimate exposure being kept within 15%. And we did that with this deal. We made a decision because it was a very popular deal, and a lot of people wanted to be a part of it. We needed to lock in a capital structure, and there were some regulatory approvals and things that were going to take quite a bit of time. So we decided we would not only commit 15% of our fund, but another 15% of the fund to bridge some of that capital until we got through the regulatory process, and then we would sell that down to other investors. Not to get into too much complex detail, but that meant that we were taking 30% exposure to this particular deal. But we thought we had good visibility into being able to sell that down. Well, what happened between the time we took the exposure and the time when we were going to be able to sell it down is that the world changed. The global financial crisis ensued. That meant a lot of things changed around this business, around investor appetite, and when that happened, nobody was interested in buying this bridge that we had exposed ourselves to, and the particular business we were involved in had some very negative impact from the global financial crisis and ended up struggling significantly. And I would say at the same time, this gets back to this was, and our mistake was compounded by the fact that we had just raised the largest fund in Japan, and to do larger deals like this one. But after the financial crisis, larger deals did not persist. So we ended up not deploying all of the fund. So just rough numbers, it was a $2 billion fund. We had 30% of it allocated to this one deal, so $600 million. But then we ended up not investing all of the $200 million. We returned commitments to investors. We only had about 1.2 billion of this that was actually invested. So we had half of the fund almost allocated to a single deal, and that deal did not deliver return. So you had half of your fund basically write off. And without getting into too much more gory detail, but the point is, okay, in our investment world, sometimes investments don't work out, and there can be external factors and other things that happen. But if you adhere to your exposure policies and limits, if an investment doesn't work out, at maximum, it's going to be 15% of your fund, and you can make up for that with the other 85% of the fund. And in this particular case, it became 30, and then actually ended up in 55% of our fund was exposed to a single deal that didn't work out because of the decision we made to bridge and expose ourselves to that. So the learning from that mistake is that we have built in even more rigid exposure limits. We've taken away the ability to bridge an additional exposure to a deal, even though most funds in the world have that mechanism. We've just eliminated it from our funds in the language of our funds, so that we're not even tempted to do that anymore. And if we want to do it, I guess theoretically we could, but we'd have to get all of our investors' approval to do so, and that itself is a hurdle that you just don't want to try to go through. But
of course.
So even if that deal had failed, we could make it up with the rest of the fund. Incidentally, and so that put us in a dark period for 3 or 4 years where we had to make up with the other 45% of the fund to see if we could salvage that fund. We did. 55% of the fund was a 0. The other 45% of the fund was a 3.9x, and we ended up with a 1.9x overall return for the fund, which at the end of the day, investors really appreciated our persistence and our perseverance to make something that fun. But that led to probably a 5, 6, 7 year period where we were really set back because of the poor decision we made on exposure to that deal.
Wow, that's an amazing lesson. I think that's very impactful. That's a lot of money, and luckily you were able to make it back. But that must have been a lot of struggle and a lot of.
No, it was,
personal-
and not everybody in our organization stayed to see it through. They realized, okay, if that's what's happening, this fund isn't going to deliver any carried interest or success fee bonuses for them. So we had a good part of the organization that left us, but the people that stayed, they and persevered and delivered the nearly 4x on the rest of the fund. They are some of the most talented, capable, experienced, seasoned, whatever you want to call them, investors in the industry. And so they all, learned from that experience, and our organization became much, much stronger as a result as well. Whatever doesn't kill you makes you stronger kind of thing. This is the kind of thing that almost killed us, but we didn't die, and we came out of it a lot stronger.
Congratulations. That's truly really impressive. I don't know if Christine would like to hop back on. That was the end of my questions. Thank you, Mr. Folsom, for the opportunity to interview you. It's most
Sure.
definitely been a pleasure. I've learned a lot. I'd love to stay in touch with you.
Sure.
for this.
I've enjoyed it as well.
Thank you. I really appreciate it. And I think that all the members of Young Investor Society could take a lot from this interview. So I appreciate you sharing your knowledge.
Thank you. And best of luck to you going to college now very soon and embarking on the next stage of your career.
Thank you. I appreciate it. I'm sure this won't be the first time we talk, and I'm sure you'll go on to see me do great things.
I'm expecting that. Yes.
Thank
Gabriel,
you.
thanks again for a wonderful interview. Richard, lovely to have you. Great seeing you again.
Thank you.
Your insight, of course, much appreciated.
Happy to be here. Happy to support YIS. I love YIS, Gabriel, and really appreciate seeing the impact it's having on lives like yours.
Thank you. Okay, well, I guess that concludes the interview. Christine, what do you think?
Absolutely. Rich, James, did you have any last words?
No, just amazing job, Gabriel, and thank you so much, Richard.
Well done,
What great insights. Yeah, just well done. Proud of you, Gabriel.
Thank you. I appreciate
right.
it. Thank you so much, Mr. Fletcher. Bye.